Welcome. We shall be having the webinar on derivatives, and we'll be covering the basics of derivatives trading. And the structure of the webinar is such that we'll be talking about basics of derivatives markets, futures, and futures as instruments and how they work, what are options and its potential. Also, I'll be talking about some key trading concepts, wherein I'll be covering open interest as well. So coming to derivative instruments, we need to understand that there are different asset classes, such as we have equities, commodities, and currencies. Also, amongst the different asset classes, we have different types of financial instruments which are available for trading and investing. So we have something called the cash segment or the equities market. Then we have something called the derivatives market, wherein under the derivatives we have futures and options. So these are leverage instruments deriving their value from an underlying and have an expiry date. So you will find that all the futures and options which are traded on the exchanges, they are derivative instruments, and they have some features which are common, and these features are common, be it India, be it Europe, be it US. The commonality remains the same. So these derivative instruments, first of all, the word derivative means that they are derived from an underlying asset. So that's one. The second is that these are leverage instruments. So effectively, what it means is that you can or one can take a position in derivatives with leverage. So if one has, just to give you an example, that if one has 10,000 rupees in the account, in derivative instruments, one can take a leverage, and the margin requirements also could be that the position one could build could be of 1 lakh also. Whereas in the cash segment, you have 10,000 rupees in your account, say for example, so you can take a position worth 10,000, or if you have a 1 lakh rupees in your account, you take a position worth 1 lakh. But derivatives gives you that leverage, that opportunity. So there are opportunities as well, but at the same time, one needs to understand the risks as well. So the other major advantage of derivatives is that you can trade the market both from the long side and the short side, depending upon whether you are bearish on the market or you are bullish on the market. So if you are bullish on the market, and then you can be long using derivative instruments. But at the same time, if you're bearish on the market, you view the market as that there could be some correction or some major negative event is likely to happen. So in that case, you can go short in the market using derivatives. So for example, if you are trading futures, which is a derivative instrument, again a leverage instrument, so you can sell futures at a high price and cover it at a lower price. So you have that advantage. Whereas in options, if you're bullish on the market, you will buy a call option, and if you're bearish on the market, you will buy a put option. I'll be talking about options in detail later on. So derivative instruments, they offer opportunities to traders who take the time out to understand them well. And the best part is that you can buy or you can take a position in derivatives, that is futures or options, and you can, if you're making some money on that trade, you can exit it even in 5 minutes or 10 minutes, depending upon your interest or your trading psychology. So to sum up, derivative instruments are, these are primarily exchange traded derivative instruments, that is futures and options, which have an underlying asset. So, for example, Reliance stock as an underlying will have Reliance futures, or it will have Reliance options. So, you can trade these derivative instruments. Secondly, these derivative instruments, they have an expiry date. So you will find that all these derivative instruments have their expiry date. So that is the last last trading Thursday of the month, wherein the contracts expire. So, but at the same time, you can roll over the contracts if you so wish. So, as I was saying that these are leverage instruments, futures are leverage instruments, they are exchange traded, and futures to talk about, they each have its own contract specifications. But generally, there are some rules which govern the futures market, wherein the expiry date is the same, and also you will find that the futures contracts are available for different months. You have the near month future, then you have the mid month future, and the far month future. So if it's a month of April, and April is the near month future, so the next month or the middle month future is called the May, and the far month would be June. But you will find that mostly the liquidity is in the near month future. So whenever you are trading derivative instruments, you should look at which are the most liquid contracts, because there you will find the bid and ask spread also less. Also, one can trade, as I said, on lower margins. So the margin requirements are very low. The margins could be anywhere from 10-15% to as much as 30%. But still, that you have a high leverage, and intraday you get enormous leverage if you so wish to trade as well. The next is that futures contracts, as I talked, they have expiry dates, so they expire on specific dates. That is the last trading Thursday of the month. So, so you have to keep this in mind when you are building positions, when you are taking a position. So, ideally, if you are buying or taking a position, if you're taking a position a day or two ahead of expiry, you need to understand that you will have to square off your trade or roll over your trade to the next contract. And the beauty of futures instruments is that you can trade on both sides, that is the bullish and the bearish. So that gives you a very different perspective against the investor who just trades on the buy side. So this is an opportunity which you can take advantage of. So next we look at options. So options, basically the word options are that they give the buyers the right but not the obligation to buy or sell a specified underlying at a set price on or before a specified date. I will just clarify this, that basically what it means is that the options, again, these are derivative instruments, wherein if you are a buyer of option, you pay a premium, and that is the maximum risk that you have when you buy options, be it a call option or a put option. So when you are bullish on the market, you will buy a call option. Whereas if you're bearish on the market, you will buy a put option. But here you need to remember that in futures, the risk is unlimited, meaning that if you buy a futures contract, and the market corrects from there, and if you don't have a stop loss, so your loss can be significant. So you need to have strict stop loss when you are trading futures. Whereas when you are buying options, the maximum loss that you have when you buy an option, be it a call option or a put option, is the premium amount that you pay. So we will look at examples also to clarify it further. So for now, you need to understand is that basically we have futures and options as derivative instruments. These are exchange traded instruments, and they have their expiry dates. These are leverage instruments, and one needs to understand them properly before taking a position. And at the same time, these derivative instruments gives you the opportunity to both trade the market from the long side or the short side, depending upon the view that you have. So the next question is, why trade with options? Basically, you need to understand is that options, they first of all, if you are having a position in the cash market, options can be an effective hedging tool for your existing positions. So that's the first one. Secondly, is that attractive returns are possible, wherein the possibility of a large profit on the back of a small capital outlay is possible. So options, for trading options, you require even less capital as compared to trading in futures. So the returns also are significantly, the percentage returns are significantly higher when one is trading options. But on the buying side of options, then limited risk. As I said, an option has an inherent hedge in it that losses are limited to the premium paid. So whatever is the premium that you pay when buying a call option if you are bullish on the market, or the premium that you pay when you buy a put option when you're bearish on the market. So that is the maximum risk that you face. So no matter if the market moves strictly or enormously against you, still your loss cannot be more than the option premium that you have paid. So that is one way of limiting your loss no matter if the market moves significantly against your position. Whereas this is not the case in futures. So you need to understand that futures, the risks are unlimited, whereas in options, if you're on the buy side of options, your risk is limited to the option premium. Then what happens is that volatility in option markets is quite high. So the possibility of making returns is also higher. And options, you have strategies in different market segments, whereas if the uh, if the overall market is trending, then you can have option strategies as per that, and if the markets are trading in a range, you can have option strategies for that. But before getting into option strategies, you should rather look at buying a call option or buying a put option depending upon the view that you have. So now let's take an example. So this will clarify uh, uh, the points which I have raised and help you understand even better. So we have two gentlemen here. One is Harish. So Harish has invested in Nifty futures when the market is at 8,400 levels. Whereas Manish has invested in options and he has bought a call option at 100. So the premium is 100 for a 8,400 strike. Now if market falls by 100 points, then what happens? So in this case, Harish, who has bought a Nifty futures, so he will now lose, because the lot size is 75, so he will lose 75 into 100, that is 7,500 by trading in Nifty futures. Whereas Manish, who has invested in options and has bought a call option at a 100 rupee premium for a 8,400 strike, so he will lose 75 into 65, that is 4,875 by trading in Nifty options. Here you need to understand is that there is something called delta, which is you can see that it's mentioned as star, assuming delta is 0.65. What it effectively means is that for every 1 point move in the Nifty, the option premium moves by 0.65, that is 0.65. That's the reason we have multiplied 75 into 0.65 into 100, so you get 4,875. So what this means is that whenever you are buying options, you should look to see what is the delta of the option. That's one. Secondly, when you are buying options, you should also ensure that you don't buy too uh, deep out of money options. We'll talk about that as well. And at the same time, if you're buying options, you should try not to hold them for very long, because the value of your option premium will keep on reducing every day if the market really doesn't go your way, and also the speed at which the market moves in your favor is also crucial and important, because otherwise the option premium will get eaten away over a period of time. So in this earlier example, we looked at when the market has corrected by 100 points. Now we look at the market rises by 100 points. So in this case, what we see is that Harish gains 75 into 100, that is 7,500. So this 75 is the market lot of Nifty. So if you are trading or looking to trade in stock options, you should understand what the market lot of that particular stock option is. You get that these data very easily available. So you should look at what is the market lot before taking a position. So in this case, we see that Nifty moves up by 100 points. So Harish gains 75 into 100, that is 7,500 on an investment of 30,000. Here we are assuming that the margin for Nifty futures is 30,000. So he has made a return of 25% on an investment of 30,000. Whereas Manish, he gains 75 into 0.65 into 100, that is 4,875 on an investment of 15,000. Here we are assuming that the margin requirement is far less for trading options. So you can see that the return on investment on trading options is significantly higher as compared to the return on investment when you are trading futures. So you need to look at it from that perspective, but at the same time, as I said, you should not trade too deep out of money options. One, secondly, you should not hold your option positions for many days if it is not moving in your favor, because the option premium will decrease or decline by every day till expiry, when it becomes if it's out of money, so the premium will become zero. So there are some winning option trading rules as to what options you should buy. So as I said earlier, that you should stay away from deep in the money options. There are three types of options. You have in the money options, at the money options, and out of money options. So the first rule while trading options is that you need to stay away from deep in the money options. The basic key advantage to buying options are the high leverage and the limited risk. So if an option is deep in the money, it cuts down on your leverage and adds to your risk, because if it is deep in the money, you pay a significantly higher premium when you want to buy that option. Also, the biggest disadvantage of this option seller is time decay, and deep in the money options have less time decay. So what happens is, generally there is an option buyer and an option seller. So for an option seller, if he's selling a deep in the money option, the time decay is less. So, and also if you are an option buyer, so you should avoid buying deep in the money options, because the premium that you will pay is very high. The second is, you should stay away from deep out of money options. Deep out of money options, they give you a lot of leverage, but in reality, it just gives you a lot of hope, encourage overcommitment, and generally offers little profit opportunity. So what it effectively means is that, say for example, if Nifty is at 8,400 levels, so you have the all the lower strikes will be in the money. So you have 8,350, 8,300, 8,250, 8,200. So these are becoming deep in the money options, and out of money options will be 8,450, 8,500, 8,550, and you'll find that even 9,050 options are available. So though they are deep out of money, so there you will find that the option premium that you pay is very less. So you need to be careful when you are buying options. So you should avoid buying deep out of money options. Then the next question comes is, then which type of options ideally one should trade? So one should look at trading slightly out of money options, slightly at the money options or slightly in the money options, because these options, they have a reasonable chance of proving profitable when buying. You gain from the maximum possible time decay when selling, and they are generally the most liquid. What happens is that if you're on the buying side of option, generally you should look at buying slightly out of money, at the money, or slightly in the money options. Because there, when you're buying slightly out of money options, you are paying less premium as compared to if you're buying deep in the money options. Whereas at the same time, when you are buying options, as I said, that if the option doesn't move in your favor, so there is something called the time decay. So the option premium, you will find that is decreasing. And secondly is the delta of that option. So if the delta is low or less, so if you're buying a out of money, deep out of money option, you will find that the delta is very less. So even if the stock moves up significantly, or Nifty moves up significantly, or Bank Nifty moves up significantly, you will stand to make very less money because the delta is very low. So you need to understand this. So it doesn't really make sense to buy deep out of money options, because generally you will find that they are very cheap, or they appear to be very cheap. So you think that it is a good idea to buy, but generally that's not a good idea to buy until and unless you have some specific reason to buy that option. Otherwise, you should generally avoid buying deep out of money options or deep in the money options. Then you need to understand that there is a time for all seasons. That generally what happens is that the uh, illusion, there is an illusion that deep out of money gives you a lot of leverage. So if you're buying deep out of money option, it gives you a lot of leverage, but the reality is that it just gives you a lot of hope, encourages over commitment, and generally offers very little profit opportunity, because in that case the market has to move significantly in your favor, and that also in a very short span of time for your option to make money. So you should avoid deep out of money options. And the next is that once you are trading options, once you are trading futures, primarily more so on the futures side, you somewhere need to maintain your stop loss. Because if you are maintaining your stop loss, you can still minimize your risk, because ultimately that is the key. People who can minimize their risk are the ones who really stand a chance of trading profitably in the markets. So somewhere or the other, and also more so when you are trading futures, because in futures what happens is that you have the markets can go against you, and if the market goes against you, then in that case you will find that the market can go significantly against you. So you somewhere need to have a stop loss. There is one issue, however, that you have a stop loss, but you carry forward your position. The next day, the market opens. Suppose you're on the buy side, and the market opens lower. So in that case, you are not your stop loss does not get triggered, and you are caught on the wrong foot. So that is part of life, that is part of markets. One really can't do much about it. So the point here is that you should not bet or place too much, or take or put your entire capital at risk on a particular trade. You should diversify. That is, you should take small trades rather than take one large trade. So now the next point is that when you are trading, avoid trading in the first 15 minutes of the day. Generally, what happens is that no matter which asset class you trade, whether you trade the cash segment, you trade the futures or the options, always wait for the market to settle when once the market opens at 9:15. So 9:15 to 9:30 is ideally a time when you should wait and watch as to see how the market settles, and then take a view of the market, and then you can trade. But it's not advisable to trade in the first 15 minutes of the day, because generally all the news flows which have come in post the market closure and before the market open, they get reflected in the market price or the share price. It takes some time to stabilize. Then the next is that never do averaging of losing position. As far as possible, avoid, if you are in a losing trade, your trade is not making money, don't try to average that trade, because that could be risky if the market still goes against you. So you have a double. Rather, you should look at averaging when you are in profit. So if you are profitable, if you are in a profitable trade, then still you can buy, you can take a position, but there also you need to have your stop losses in place. The other point is that as the option nears the expiry, the value of the option reduces due to time decay. This I have explained, that you will find that if you take one position in the futures and one position in the options, and if the market does not go anywhere, and just to give an example, suppose you have bought Nifty futures, and you have at the same time you bought Nifty options at 8400 strike at a premium of 100. So now Nifty futures does not go anywhere for the next week or so. So in that case, on the futures position, you will not make any loss. But do you think that in your options position, that is the Nifty call option which you have bought at 8400 strike, the premium will still remain 100? No, you will find that the premium will reduce significantly, and from 100 it could now be maybe 60 or 65 or 70, or maybe even lesser. Why is that? Because this is something called the time decay. So you need to understand that when you're buying options, be it a call or a put option, the faster the market moves in your favor, the faster the market moves in your favor, the better it is, the better it is. So that's important on the time decay side. The other point is that, as I said, is that losses are limited in terms of buying of options as in comparison to selling of options. So there are professional traders who are on the sell side of options, but you need to understand that selling of options is a risky business, and one should not get into selling of options until unless one really understand the do's and don'ts of trading, and the major fundamentals of options trading. Also prefer to take view in options closer to market price, that is, an in the money option is better than out of money option, or you can take a slightly out of money option is also fine, but don't because what we see is that many traders like to buy deep out of money options in the hope that they are paying very cheap and they are buying something good. So that's not a good idea. So you should buy. So just to give you an example, so if the Nifty is at 8390, and so the next strike is 8400, then 8450, 8500. So you can, then you will also find strikes of 9000 as well. On the lower side, you will find strikes of 6000 as well, 7000 also, 8000. But rather one or two strikes above or below is fine when you are buying a call option or a put option. Slightly out of money is a good idea to buy. So there you will find that the delta is also higher. That is generally to be in excess of 0.4. So that means that for 1 point move in the Nifty, the option premium will move by 0.4. And at the same time, you will find that the possibility of making money also increases, because the option premium that you have paid and the delta being higher, that gives you that opportunity. So lastly, to sum up, there are some common mistakes by, I would say, investors or traders. One is the lack of knowledge. So a lack of necessary knowledge is required to choose the right stocks to invest, or I would say the right strategies to trade, whether one is trading stocks or whether one is trading futures or options. So there's a very nice thing that if one feels that knowledge is expensive, try ignorance. So overall, gaining knowledge should be part of everyone who is into the market, because you need to understand that market is a collective wisdom and collective coming together of all the intelligent beings who are the market participants. So to win in that game, one really needs to keep on upgrading and updating one's knowledge, while at the same time managing one's emotions, which I'll talk about next. So apart from the lack of knowledge, the second mistake that we see is lack of patience. Sometimes there is a hurry to either book a profit or to get out of a trade, which is not a good idea. So somewhere or the other, you should uh, look at holding your positions where you are profitable, and cutting your losses where you are in a losing trade. Because again, there's a very nice saying that generally what happens that when one is in profit, one becomes a trader, and when one is in loss, one becomes an investor. So that's not a good idea, and particularly more so when you are trading leverage instruments like futures. So that you should be careful of. And the third is emotions. Generally, we are emotional beings, so we all act on emotions or react on emotions. But we need to understand is that in markets there is no place for emotions, because the market is actually trying to play you against your emotion. So if you can somehow manage to have some clear-cut rules identified, which can help you trade in a disciplined manner, be it futures or options or any asset class or equities, you need to understand is that some control over your emotions in terms of having some rules, simple rules also, will go a long way in helping you trade successfully. And the fourth point is risk management. It what if effectively means is that generally we've seen that booking a loss or getting out of a losing trade is something which is very important, and successful traders and investors have somehow managed to master this, which is difficult because it is a psychological and emotional decision to get out of a losing trade. But that way you save yourself from a significant loss, because again there is a very nice saying that the first loss is the best loss, or one will take the mother of all losses. So what it effectively means is that once you are entering a trade, you should be very clear as to where to get out of a losing trade before entering a trade, because once you are in the trade, it's just like swimming. You jump into the water without knowing swimming. So what will happen? You will go along with the flow of the river. So the point here is that before entering a trade, you should know, okay, this is my entry point, so this is my exit point, in two ways. One, if you are if you are in a profitable trade, then how you need to exit, and secondly, if you are in a losing trade, then what is your exit point. So these are some common mistakes which are made by investors. But what we've seen is that those who take out the time to understand how the market works and understand the rules of trading, and also understand the basics and fundamentals of futures and options, they still go a long way ahead of the crowd that is there in the markets. So we will now take your questions. Thank you.